Thank you very much, and I'm delighted to have an opportunity on speaking on this particular bill, Central Bank and Credit Institution Resolution Number 2 bill, and it is a very important piece of legislation. Listening to the previous Fianna Fáil speakers, you would have imagined that they're taking responsibility for the conception and delivery of this legislation, and we're just introducing it here in the Dáil after they've done all the work. Certainly, our spokesperson on finance, Joan Burton, had been looking for this piece of legislation for 2 years, and it didn't appear. Likewise, it's not true to say that the European Commission hasn't produced its framework the European Commission has a framework document for crisis management in the financial sector. In fact, this bill is based on that document. It produced it nearly 18 months ago, and this is where it has come. The government could in fact have produced this bill long ago, and it could have gone through Parliament before the election, long before the election or the equivalent. So I think you have to recognise the reality of the situation, that a lot of mistakes were made, and that the purpose of this legislation is to look to the future to ensure that those mistakes are not made again. And that has nothing got to do with the ECB, good, bad or indifferent. If each nation puts in place its regulatory reform system in relation to how the banking sector is going to operate, and if there are proposals in place with mechanisms that govern a resolution regime in a proper fashion, whether or not it's an ailing bank, whether it's a failed bank, whether it's a bank that can be resuscitated, then you're able to deal with it for the future. And if there is a fund in place, a resolution fund in place, as proposed in this legislation, then the matter has been dealt with in advance. So it's preparing for the rainy day in that respect. So it's better not to introduce irrelevancies that have nothing got to do with the legislation in itself. The bill is particularly important because of what happened in the past. And it's important that we must ensure that the Irish financial institutions that almost ruined this country, and still we're not out of the woods by any means, that this cannot happen in relation to them again. There was the perception abroad that somehow the banks, and every bank seemed to be a systemic bank, when that was the mantra that was out there, could not be allowed to fail. That was the perception that was out there. And that is what has brought us to the situation we are here at the present time. The previous government handled the economic crisis with that view, and in that respect the Irish taxpayer was left out to dry. We must remember that banks are like any other private business. They can fail, and they must be allowed to fail rather than propping them up if they are not able to survive. And indeed, they must be properly interred when they do fail, so that they cannot spread contagion. Now, the Central Bank and Credit Institution Resolution Number 2 bill provides the statutory mechanism for an effective screening and indeed for a decent burial for those failed banks. And where the condition is one of an ailing bank which is not terminal, the bill also provides for structures and mechanisms for its resuscitation and its rehabilitation. And it's stated clearly in section 4 of the bill that the purpose of the bill is A, to provide an effective and efficient resolution regime for authorised credit institutions, and secondly, to provide for a resolution regime for such credit institutions that is effective in protecting the exchequer, the stability of the financial system and the economy. So it's difficult now, looking back 3 years, when the given wisdom was that the failure of a major bank like Anglo-Irish could not be contemplated, even though it was rotten to the core with debt. So what ended up was that the previous government bought a pig in a poke in relation to the bank guarantee, convinced the other political parties, with the exception, of course, of the Labour Party, to follow suit. And indeed, it is difficult to look back now and to envisage an entire private banking system being given a guarantee by the state of protection by the taxpayer to the tune of 500 billion. If Sinn Féin in particular, whom we hear loudest on the benches here, knew then what they know now, or if they had thought about it properly, they would scarcely have voted for the taxpayer to bail out the private banks to the scale of half a trillion euro. That was the time to burn the bondholders and protect the taxpayers. But rather than doing that, Sinn Féin went into the lobbies here and voted for a private bailout, a bailout by the citizens for a private banking system. The programme for government and this legislation makes it quite clear that the old ways are over forever. And I quote, "We will introduce a comprehensive special resolution regime for dealing with bank insolvencies," end of quote. And furthermore, the programme for government makes it clear that the burden of dealing with impaired or failed banks will not be shouldered by the taxpayer. Rather, the banking sector, which caused its own failure in the past, should in future contribute to a resolution regime for in the coming years. Thus, quote, "The government accepts that enabling provisions in legislation may be necessary to extend the scope of bank liability restructuring to include unsecured, unguaranteed senior bonds," end of quote. So the full rigours of the marketplace must apply to the banking sector, and private debt must never be allowed again to become sovereign debt. Already, the first steps have been put in place. The Credit Institution Stabilisation Act 2010 provides for the reorganisation and restructuring of the domestic banking system in line with the recommendations of the EU-IMF programme of support for Ireland. Recapitalisation, restructuring and reorganising of assets and liabilities of the credit institutions are being implemented at present. Anglo-Irish Bank and Irish Nationwide Building Society are being wound up, or wound down, whichever the case may be. 5 credit institutions are now state-owned, and 2 pillar banks are in the process of being built up to trade profitably. Most of the impaired loan portfolios have been purchased from the banks by NAMA at an enormous haircut of 58%, though even that reduction is probably on the generous side compared to the real value. Only 3 billion worth of loans remain to be reviewed and transferred to NAMA. It is expected that the restructuring will be largely completed by 2012, and then the Credit Institution Stabilisation Act will lapse. At that time, this bill will be activated. Now, the purpose of the present bill is to take over once the banking system is stabilised, and to provide a permanent resolution framework for the future should the evil day ever loom again. It is crucial that the 29th of September 2008 night never happens again, that there be no late-night mugging of an Irish government and the Irish taxpayer by those in the banking world who put private greed and self-preservation before the interests of their country or the welfare of the people. Under the provisions of the bill, the Central Bank will be substantially in charge of the entire operation. The Central Bank will, in the first instance, make the decision to intervene in the operation of a particular credit institution. It will have a toolkit for repairing the alien institution, or for transferring the assets of a failed or failing bank to a sustainable bank and closing down that failed institution. A credit institution resolution fund will be built up by the banking sector for the eventuality of a rainy day in the life of a credit institution. A bridge bank may be established and capitalised from the resolution fund. The assets and liabilities of the impaired credit institution may be transferred there with a view to continuing to transact business pending the ultimate transfer of these assets and liabilities to a sustainable bank or the formulation of recovery or resolution plans. Special managers and special management orders and other resolution tools contained in the bill will facilitate the management of the impaired institution to recovery or to wind down the institution with a view to liquidation.
1 minute.
What is critical about the legislation is the acceptance that ailing financial institutions of any type or size, and crucially, systemically important institutions, can now be allowed to fail without risk to the financial stability while avoiding cost to the taxpayer. And that has to be at the nub of the solution. The EU Framework for Crisis Management document was mentioned. It was produced earlier in 2010. And of course, it is the background to this legislation. But one of the interesting statements that's made in that document, and I quote, it says, and it's a very important assertion, banks must be allowed to fail like any other business, end of quote. That is the nub of the solution, and that's what this legislation is about, putting the mechanism in place and the rules and regulations in place and the supports in place to ensure that that can happen in an orderly fashion rather than passing the burden on to the taxpayers. So could I say in conclusion that the Commission, and I'd like to go into some detail on that, but I don't have time, has been doing a lot of good work on this particular issue. It has provided the background to this legislation for each state of the 27 states, and expecting each of the 27 states to produce similar legislation. And it's also working on, if you like, a final solution whereby it is seeking to provide a single EU fund which would also be supporting the resolution of banks that are in a difficult situation. So the legislation, I commend the legislation to the House.
Thank you very much.